Hello, good afternoon to everyone, and thank you for joining us. My name is Idan, and I'll be your moderator for today. Today's webinar is hosted by Matrix IFS and Pitney Bowes, and will focus on the 5th AML Directive, which will take effect in 2020, and how a relationship-based approach can improve AML compliance when optimizing your financial crime systems. Our speakers today will be from Matrix IFS, Yair Samban, who is VP Compliance and Fraud Services in EMEA. And from Pitney Bowes, we have Anastasia Petrova, who is Head of Financial Services in EMEA, and Colin Whitmore, who is a Financial Crime and Compliance Specialist. So before we get started, just a few words about each of the companies you're going to hear from. Matrix IFS have been providing specialized solutions and services to financial institutions around the globe since 2006, with over 500 projects completed ranging from advisory to implementation of various solutions and technologies. Pitney Bowes Software and Data Solution, a software company that helps customers around the world to understand connections and relationships between people, places, and things. And without further ado, I will pass the mic to Yair, who will kick off the webinar for today.
Thank you very much, Idan, and welcome everybody. Good afternoon. Today we'll spend some time talking about the 5th AML Directive, which is a pretty important piece of regulation that the European Union has introduced last year, and it will come into effect in full across the European Union, and I believe also in the UK, regardless of the outcome of Brexit in the next 2 years. This regulation has implications not only on the legal framework and the business drivers of financial crime, but also in the operational and technical setups of many firms. Some of them are already under EU directives, and some of them will become under EU AML directives as a result of the 5th AML Directive. And really the most important aspect that I want to touch on today, which hopefully will be clear to everybody by the end of this session, is the challenges that are faced by financial institutions with respect to the 5th AML Directive cross the borders between the financial crime regime and controls and the technology being implemented. Because if you're not able to deploy the right technology at the right time, then operational overheads and potentially compliance risks might occur. On the other hand, a gradual evolutionary approach that will improve the architecture and create a relationship-based approach will improve AML compliance and improve efficiency of any firm that has a financial services operation and is regulated under the EU regulations. Feel free to ask any questions and give us any feedback as to what you'll hear today, and hopefully this will be interesting and useful for everybody. The first point that I'd like to touch on is the history and the evolution of the 5th AML Directive. Why do we even have this regulation to deal with right now? The 5th AML Directive was proposed by EU authorities on July 2016 and ratified by July 2018. And its purpose is to address gaps in the anti-money laundering regime of the European Union that were exposed in the few years before in 2016 and in the couple of years after that. So it is really timely that we see this regulation being implemented now and in the next couple of years. In 2015, the world was exposed by the Panama Papers publication to the widespread use of anonymous companies and offshore bank accounts in activity that touches on money laundering and use of the established banking system for the movement of the proceeds of crime. That exposure created an increased focus on beneficiary ownership, which we'll touch on later on during this session. The terrorist attacks that Europe suffered during 2016, 2017 in different countries in Europe exposed the fact that there are weaknesses in the system of banking and financial services in Europe that allow criminals and terrorists to use that system for their own goals, and created a very strong incentive for the regulators to come with a response. And this response came in the form of the 5th AML Directive. During the last year, 2018, we've seen also a number of major banks across the European Union Danske Bank, ING, Nordea, and others that were hit by massive and unprecedented fines as a result of movement of illicit funds through their operations. And those events also highlighted the need for a broader and more comprehensive AML regime across the European Union. The fifth AML directive basically updates the fourth AML directive, which was approved by the European Union in June 2015. The fourth AML directive is the foundation of the AML regime that is being followed by financial firms that are regulated in Europe currently. The fourth AML directive includes stipulations around transaction monitoring and sanctions and KYC CDD. And this fourth AML directive replaced the third AML directive. And what you can see pretty interesting in the timeline is that the acceleration of publication of new directives is very apparent once you put everything in perspective. It took 10 years for the fourth AML directive to replace the third, whereas merely 3 years later, the fifth AML directive has been published. And shortly after, the sixth AML directive has been ratified as well, which completes the regime of the money laundering prevention by the European Union. The sixth AML directive covers criminal offenses and penalties, which is the second half of the picture, if you want, compared to the fifth directive, which covers mainly risk mitigation in the form of collaboration between entities and the right operational controls that are needed. So between the fifth and the sixth, it is hopefully that the regime created by those regulations will create a better standard across the board within Europe. The fifth AML directive covers three main aspects. The first is an improved level of collaboration between the participants in a financial system. So the fifth AML directive gives firms and regulators and national authorities stronger tools to unravel complex corporate structures and gives them a very strong incentive to expose beneficial owners in case they might be using the system for the transfer of criminal funds. And thirdly, the regulatory remit has been broadened to cover digital currencies and prepaid cards. Those technologies, those payment methods will be held to the same standard as banks, and this has implications on the level of AML controls, technologies deployed by those firms.
And you're absolutely right here, Yair. Firms will need to acquire more data from more diverse sources in order to maintain compliance. And we will discuss later the importance of data quality and data governance. So thank you for mentioning it here.
Thank you, Anastasia. This is an important point which we'll come back to later. The timeline of deployment of the fifth AML directive starts, as I mentioned before, in May last year, where the EU Council have adopted this regulation formally. By June 2018, it came into force at the level of European regulation. That opens a window of time for all nations within the EU, all countries, to ratify this regulation within their own legislative processes. By January 2020, it's expected that all countries will ratify this regulation. At that point, beneficial ownership records for corporates will be set up by all EU states. By March 2020, it is expected that beneficial ownership of trust will be set up by EU states. And by September 2020, the regulation expects centralized mechanisms to allow identification of payment accounts and bank accounts by EU states. Whether this timeline will be followed one by one or the big deviations remains to be seen. Even the fourth AML directive was not implemented straight away according to the timeline expected. But this evolution and the very well-defined timeline will create a very strong incentive for firms to deploy the right technologies in time to meet the new requirements. So while the action to be taken now might be to analyze the requirements and to begin the journey, and sometimes it might be also to review current controls and not a lot beyond that, but it's expected that in the next few months, there will be more and more countries that ratify the regulation and make it a legal obligation to, for example, follow beneficial ownership and investigate any transactions and any relationships based on the new regime. So increasingly in the next couple of years, there will be a very strong motivation, mainly for multinational financial institutions, to be compliant with the 5th AML Directive, even though in some jurisdictions it might be implemented in a different way. In other words, most financial institutions today are multinational. They operate in more than one country, and it is highly likely that EU countries will start deploying this regulation in their legal frameworks in this year, 2019. So this is the year that compliance according to the 5th AML regulation has to be put in place in order to be safely future-proof for what will happen in the next couple of years. I'll move on to talk about specific aspects of the regulation and dive a bit deeper into each one of them. The first element is the tightened identification measures that are required of payments exceeding 50 euros, remote payments specifically. 36 months after implementation date, all remote payments will be subject to those checks. What that means is that the remote payments will be subject to KYC checks, similar to higher value payments right now. It lowers the bar for those checks, and that means that all banks and financial firms would have to use new technologies or enhance the level of coverage of the existing technology to identify customers with additional data elements. Capabilities to block payments will have to be deployed if they're not present, and all this enhancement and upgrading of payment processing and KYC controls would require new testing and operational review to make sure that the impact assessment of the impact of such changes is being taken into consideration. The 5th AML Directive includes a list of standard extended due diligence EDD checks. So where there is a potential high-risk customer, even today, firms need to conduct extended due diligence. Currently, the regime of what checks need to be performed is not uniform across all countries in the EU. There are some informal standards, but there is no baseline that is applicable by law. The 5th AML Directive would include a list of such minimal EDD checks, namely identification of the customer and the beneficial owners, intent the nature of the business relationship, source of funds, reasons for the transaction, and approval of senior management and continued enhanced monitoring. Firms that do not conduct all those checks right now will have to update their risk rating methodologies to include those checks, and that may necessitate updating, modifying systems and procedures accordingly. It will most likely involve collecting additional information and require reliable storing and quick access to those data elements. As you've heard, beneficiary ownership is one of the key themes. I keep mentioning this quite a lot in this presentation, so let's dive a bit into what that means practically. So the termination of beneficiary ownership is really a thorny subject, unraveling how each company is being owned and which intermediaries and so on. This is a topic in its own right, and technologies to manage data and create a good level of understanding of the entities involved will be crucial to this. In terms of the regulations stipulations, all EU states will be obliged to create national beneficiary owner registers, and it is expected that those registers will be deployed in different times, at different formats, and include different data points, sometimes about the same company. The directive does not include any standard about the registers beyond the fact that they need to be there and include beneficiary ownership information that is available to the state. So each state will have different levels of information about the same company, which is, by the way, the same level of confusion that criminals intend to achieve by registering their company in different countries and creating shell companies and such complex structures. To combat that, firms would have to create processes and systems to access registries from different countries and make sense of the information that is being fed to them or being made available to them from different sources. So the term entity resolution, what it means in this context, is understanding that person A or company A that is registered in France, for example, is the same person that is registered in Belgium or the same company, and the partial information in each of those registries refer to the same company and represent the same risk. Catering for this level of variety between data sources would require a high degree of agility and flexibility in the system, Add to that the fact that there are different timelines involved and different richness of interfaces between those registries. Additionally, many firms use private sector providers like Bureau van Dijk and others. So those private sector providers would have to be cross-referenced against the national registers, and sometimes the information in different places might need to be compared to each other and harmonized. Again, entity resolution is the key word in terms of the capability that is needed to create the right data foundation for the purpose of determining beneficiary ownership and being compliant with this directive. National authorities have been strengthened in the sense of their authority, their ability to request information from any regulated entity, financial institution, has been put in place formally within the regulation. That means, from the financial services industry standpoint, that technology solutions will be needed to enable flexible and quick access to the data found within the organization. So imagine that your national regulator is asking for information about a particular transaction or a particular entity that you're doing business with. At that point in time, you would want to have the information served to your regulator in a quick and efficient manner. Maybe the national authority would determine the right format for this feedback, or maybe the format will be left for the firm to determine on their own. But certainly, speed and accuracy of the information will be critical. Multinational firms would have a stronger need to create systems in place that would answer this need. But even for a local system that has different line of business, different profile of transactions and entities they are following up on and they are monitoring, they should be ready to get questions from their regulators about this activity in a fairly quick manner, because such a question would most likely represent an ongoing investigation into a case of criminal activity or an imminent terrorist attack, or maybe a follow-up based on some other kind of exposure. So the speed and flexibility of access to the data will be key in this respect. I touched before briefly on the expansion of the AML regime due to the fifth AML regulation. Virtual currencies, custodian wallets, and a few other service providers are now regulated under AML regulations as well. In some cases, if these providers are small, then the change may not be that significant to their business, but providers that offer those services at a reasonably medium or large scale, for example, exchanges between virtual and fiat currencies and custodian wallet providers and so on, they will need similar monitoring tools and technologies that are currently deployed by banks and more traditional financial institutions. What I expect to happen is a more robust discussion between those relatively innovative providers and firm that does business across the European Union in virtual currencies and innovative fintech services would be to have an adaptable and flexible data management platform that has specific orientation and maybe dedicated features towards preventing money laundering and financial crime. Because agility and cost consciousness are cornerstones of operating a relatively small and nimble fintech business. So even in the case of large enough companies that have a footprint that is of interest to regulators, they will deploy technologies in a way that will be more agile, more flexible, more open-minded than what you see currently from more established providers. At the same time, there is cross-reference and cross-movement between the sectors of the financial industry. So we can expect ideas to flow freely between providers of different kinds. Our recommendation at this point, in terms of looking into the future, and like I said before, the future is not 2 years from now. The future is 2019 as the year whereby the fifth AML Directive will start being ratified by the countries of the European Union, is to move towards a dynamic customer view. What that means is assessing customer risk in an iterative way, using a variety of data points to provide an ongoing and real-time assessment of the customer's risk. That will be augmented by machine learning and predictive analytics at the point in time where the dynamic customer view is based on a healthy foundation of data and updated in real time. That is a view that exists in some firms, but some do not yet have it. The traditional approach by financial services firms have been to create a customer profile based on onboarding data, fed by customer interactions and periodic reviews of account. This profile may or may not be linked in a real-time manner with transaction monitoring, PEP screening, fraud prevention, and so on. So there is no true view of all the risk factors that influence a customer profile within financial firms today. So I expect that in the future, in the near future, technology and architecture that creates a dynamic customer profile will be highly useful for the consolidation of multiple data sources, which will create a proper basis for advanced analytical capabilities. So transaction monitoring, open source data, PEPs and sanctions, social media, geolocation information will all feed into the customer profile, and that will be the basis for using dynamic scoring by machine learning, predictive analytics for the purpose of financial crime analysis. Without this foundation, the more advanced technologies might be less efficient, and the organization might waste its resources trying to understand data across those silos. Hence, I'm encouraging everybody to look at those technologies favorably and understand that they are key to being compliant with this with the 5th AML Directive in an efficient way. At this point, I'd like to pause and address a question to our audience. What would be your major challenge in your own organization to comply with the 5th AML Directive? There are a number of different answers on the screen, so please click on the one that most closely represents the situation you have.
Thank you, Yair. We'll just wait for a few more seconds. I see that people are still answering. I know there's a lot of text on the screen. People are still answering. A couple more seconds. And end the poll and share the results with you. I'm going to hand it over to Colin now. I'm going to take on the next part.
Okay. Thank you for that. And if you can just close the poll results window, we'll get started. Okay. Thank you for that, everyone. I'm going to just take you through looking at data, more importantly, the negative impact of data, and describe a few steps we would take to help you improve that data. As you can see from the poll questions, poor data cuts through those. And I've put up a number of points here we see for our customers. So earlier in the discussion, the dynamic customer profiles mentioned. I mean, poor data leads to an incomplete view of CPD and a failure to understand beneficial ownership. This is both for new and for your existing customers. Not only is this expensive in terms of regathering this information, but it also prevents and degrades the effectiveness of your core FCC processes, whether that's monitoring, watch list screening, negative demeanor investigation. Importantly, it can lead to a degraded view of your FCC risk. What do we mean by that? Well, if you don't fully understand the customer, it's difficult to risk rate them, and therefore you may put them in the wrong risk rate category. That has a significant knock-on then through your FCC systems, because you've got noise through the systems. And in particular, we see false positives. For example, if you don't fully understand the customer, you can put them in the wrong segmentation for transaction monitoring. False matches for screening, incorrect monitoring of parties on a wire, all of which lead to false positives, which, as we know, is a major issue across the industry and presents a major overhead in terms of resources. Not just resources and efficiency, but also effectiveness. All this noise in the system can prevent the identification of true and usual behavior, i.e. the false negative. Machine learning, AI, it promise much, everyone's talking about them. Lots of fintechs, lots of companies doing these. Obviously, poor data going into these models just creates poor results at the end of them. In our experience, and we've spoken to a number of customers and putting solutions around correspondent banking, for example, US dollar clearing, which is a high risk area and high scrutiny area by regulators. Being able to fully understand who the parties on the wire are. Are they customers of the institution? Are they third parties? Are they new third parties or third parties which have been seen before? All this depends on having good data, whether that's from a person, the party, the customer, the entity. So I think it's clear that data is a major issue for most organizations, and as we saw from the poll result, a major issue getting to meeting the requirements of the 5th MLD. What I'm going to do now is go through the steps we would recommend and we put in place with our customers to improve the data quality, improve the effectiveness and efficiency of FCC controls, systems and processes. Okay, if we could move on to the next slide, please. Okay, the first step, we know we've got a problem with data. Let's define that problem. What is the problem there? So we have this step called data profiling and assessment. This profiles physical data stores, files, logical models. It looks at things like missing data, duplicated data, misfiled data, misformatted data. Off the back of that, then you get a report as shown down the screen, which gives you an overview, call it the metadata of all the different datas, the scores, what's going on. What's important with this is not just a high-level report, and it can be, but you can drill down into actual transactions and have a look at the transactions, patterns, outliers, and many more aspects of the data. Okay, that's great. You've got a view of how good or bad the data is. The next step really is how you improve it. Well, we would also suggest actions here. For example, reformatting, correcting data, address validation, name changes, identifying, importantly, duplicates and how they could be merged. So there's a whole area there of suggestions. I think it's important to realize that because data is so fundamental, any changes need to be agreed and there's going to be a number of stakeholders. So we look at collaboration and comment from those stakeholders, be it models governance, AML sanctions, operations, frontline operations, compliance, risk management, and many others. Okay, so we've now got a view of how good or bad the data is, the patterns, what you can do to improve that. You've now got agreement to go ahead, let's say. So if we move on to the next slide, I'll look at that further. Okay, this slide actually covers a lot of detail. I'm not going to have time to go through that all, but basically there's a few steps here. First of all, let's improve the core data. There's techniques you can apply, for example, parsing the data into correct fields, normalizing addresses, that's quite key, using standard address databases. I mean, we have over 250 of those which can be applied. Standardizing names and terms, for example, company terms, nicknames is Robert and Bob, one of the same. So again, there's all databases can be used for that. Transliteration, so from one language to another, for example, putting stuff into Latin script to aid better matching. And then general formatting and standardizing, think of say phone numbers, many formats, moving to a standard international format so they can be easily compared. Once you've gone through your data quality and you've got your data in a good position, the next one is matching or entity resolution. This is quite key. So there's again a number of algorithms. We've got over 20 you can apply, but the key thing is here is applying the right algorithm to the data, but more importantly, understanding it that you as a customer in control of that process. You would decide the thresholds, you would work with us, tuning, testing the different thresholds, making sure for any fuzzy matching, you fully understand what's going on there. And this is an auditable process. What's important, what we find with our customers is a need that they can explain this to themselves, to their auditors, and to, importantly, to the regulators. It's not a black box process. Out of any matching, you've got to have a survivorship merging, and then you create a unique ID. That's quite important. That should be a globally unique ID. It can be for a customer. It can be for a party. and then or another entity, and then you use that in all of your processes. That's fed through, whether that's monitoring, screening, adverse media lookups, whatever you're using. That helps reduce noise throughout your processes. What's important also, and we've discussed it earlier, is the network view. Anastasia is going to cover this off in more detail, so I'm not going to say much here. But what we do is make sure that all our data, all our resolved entities, links go into this network view, as you can see an example there, and that can be used further for analytics and visualization. I've got one more step to cover, so if we go to the next slide, I'll just talk about that. Okay, that's not fully displaying properly at the bottom part, but there we go. I'll talk through that. Okay, so we've now got better data. We've now merged duplicates. We've now got a single view of the entity with a global ID. Because we know location, we can add geocoding, location intelligence to that. You're looking at demographics. You're looking at, is this an actual physical location? Is it a true address? Which country is it in? Is it a multi-tenancy, and who are those tenants, other tenants? And also, does the gathered CDD you have match that location? For example, why is a factory located at a residential address? That seems a bit strange. What about payments? Are there many payments coming from the same actual location? Could that be an MSB, but it hasn't been described as one? Could it be another operation going on there? Is something unusual or suspicious about that location in terms of your CDD and the monitoring you're getting? And then what about the person? There's a lot of data on people these days which you may not have gathered as part of your CDD processes or have in your existing database. For example, LinkedIn, Twitter handles, employer details, emails, all this social data which is out there, which can enrich the profile of a person and help for a better understanding of who that person is, what they're doing, and the activities they're doing. For companies, data can include things like the industry and NAICS codes, data, company ownership, and other information about the company. So what we're doing here, to what Yara said before, we're creating a dynamic profile. We're enhancing it now that we've got good data, single view of the entity. We're enhancing that profile with location, social, company data to give you a better view. And this all feeds into your understanding monitoring, and in particular the network analysis and visualization. So that was a quick tour of what we would do, and I'm going to hand over to Anastasia on that. So next slide for Anastasia, please.
Thank you very much, Colin. So when you know what data you have, improved its quality, created enriched profiles for customers and third parties, validated their location and digital footprint, that's what Colin talked about, you now can understand the connections between the parties and derive meaningful links, uncovering patterns that are difficult to detect using traditional representations such as tables, for example. The central component of the relationship-based technology is a graph database, which you can see the representation on your screen, which stores the information as nodes and relationships. And in the provided example, a customer is expressed as a node connected to other nodes, which constitute community of linked entities. And you can quickly see the nature of the relationships, UBO structures, discover fraud rings or victims of the crime. The next thing coming into play is pattern-based analytics empowered by machine learning. And here, next slide, please. So machine learning, and it is a component of artificial intelligence, have become a big part of our everyday lives in a very short period of time, and actually becoming sometimes just buzzwords, limiting the perception of the terms to computer systems, software, robots, and machines replacing humans. However, latest research has proved that it's far from accurate. And in the near future, AI will mean robots and humans working together to achieve better speed and improved accuracy and quality of decision making. And there are quite strong views that far from being artificial, this intelligence would better be described as augmented. That's why we are putting here some thought for review, artificial intelligence or augmented intelligence. Though we can have a constructive debate about it if we have more time. but you're welcome to discuss it offline, guys, if you want. So actually, AI has brought us an era of black box decision making, that is casting aside traditional decision-making processes, the kinds that have been made by consensus in the meetings between people or driven by human-programmed business rules. And many fintech startups these days have embraced ML-based or machine learning-based black box techniques to reduce the amount of work needed to invest in the development of rules to simply automatically resolve entities. But actually, again, the recommendations would be that there should be a more balanced approach, balanced and measured approach that should be taken here, especially when you're trying to justify to a regulator why you think someone might be committing money laundering. So here, it's always good to use the intelligent techniques like data science and machine learning to furnish the subject matter expert with the best set of rules to apply to resolve the entities, aggregate alerts, and reduce investigative burden. In doing so, full transparency over the rules that are used to make a decision can be maintained, and you increase efficiency and precision across your ML processes and systems. Next slide, please. So, and here's our final step. So we'll talk about enhancing the network visualization. So as you start evaluating where you're going from a technology perspective, you need to shift from the view of how do I solve the problem right in front of me, and start thinking more about the capabilities you want to have moving forward. And here I'm talking about next generation ML, from process orchestration to smart process automation and decisioning. It's less about buying just a rules-based system that's going to do X, Y, and Z, and more about how can I use network analytics to help me find things I don't know about. So thinking more in terms of capabilities than point solutions. For example, if someone deposits £10,000 in cash, I want to know what happens if they deposited 1,000 in cash 10 times. So here you must use analytics to start to identify patterns in a broader sense and understand interactions and connections, and recognizing or identifying that quite few of my customers all transferred money to the same entity outside my bank will be an indication that something unusual is happening here. So you're looking for those types of patterns of behavior as opposed to a predefined rule set, and with the analytics that you have now, if you can improve the data and you can increment the data and apply intelligent analytics to think more in terms of behaviors and patterns of activity, then you can start to move toward a predictive view of what your data is actually telling you. And you need to make sure you're listening to it and do a better job of understanding what risk is actually occurring within your organization. And as a result, you design better controls upfront to prevent it, and also enhance the process of detecting anomalies and identifying suspicious activities more efficiently, and are able to shut down the venues that the criminal activity is eventually proceeding through. Next slide, please. And finally, to summarize all that my colleagues and I said above, maintaining compliance starts with looking at your data and compliance process as a whole. So if we look to AML as a whole, instead of thinking of just KYC or just risk assessments and all the elements as being separate items, you need to think about how they are interrelated, interconnected. Otherwise, you end up spending a lot of money and do not really get that overall picture. And if you don't have the technology in place to support them, then you will not be able to see that picture. And inefficient technology solutions means organizations waste time and money investigating a plethora of false positives while continuing to let false negatives slip through. From our experience, there is no need to blame your ML systems. They work well as designed, but are hampered by poor data quality, what Colin was talking earlier. A holistic solution to compliance tackles this quality issue without the need to rip and replace existing tools. Powered by this good quality data, the fine focus of ML technology, and the ability to clarify identities and reveal the broader relationships that the graph database possesses are complementary and essential tools in the effort to improve compliance in the ML space. When you choose the new technology or review your existing technology, we would like you to ensure that you make the following considerations. So, are you looking for a large-scale implementation or a series of smaller wins? Does the solution resolve your data quality issues? Do you need global or local country coverage, especially for the global organizations? Do you have visibility of software thresholds, processes, and algorithms? Is it easily configurable, flexible, agile? Does it provide advanced network visualization empowered by machine learning? And how future-proof is the solution? Is it scalable enough for your growing volume? So that's why I would like to finish my presentation and hand over back to Yair and Idan.
Thank you, Anastasia, and thank you, Yair and Colin. I see that we have so we're quite good on time. I would like to, before jumping into the Q&A section, I would like to have another poll question. It will be interesting to know, like, when do you expect your firm to deploy a new technology in preparation to the 5th AML Directive? So how far along are you in the process, and if you have any plans towards making changes to adapt to the 5th AML Directive? I'll give you a few more seconds to answer. Okay, so we can see the majority of people haven't decided when the new technology will be deployed, and very few actually started deploying their solution. We'll now move to the Q&A section. So if you have any questions, feel free to write them at the window, and I will pass them along once they are through. There you go, we already have one. No surprise about Brexit. What do you anticipate will be the impact of no deal or hard Brexit on the alignment between UK and EU on AML directives?
So I would say that security and combating financial crime are key objectives of both the UK and the EU. That's something that was never in dispute. So my expectation is that in terms of the government and the political incentives, there will be towards an alliance or similarity between the regulatory regimes. Now, the main question is whether the UK will ratify the 5th AML Directive or not. I would guess that the expectation is that it will, even without a formal agreement to do so. So it might not agree to the whole stipulations of the 5th AML Directive, but I do expect the essence to be part of the UK regime, even going forward, assuming a hard separation. And the reason to that is that determination of beneficiary ownership and ability to report on suspicious activity and ability of the firms that deal with cryptocurrencies and wallets to be regulated under AML regimes is something that I would expect the UK government to want to achieve, even assuming a separation. So the short answer is I expect the very high level of similarity on this point between the two entities.
Thank you, Yair. I'll move on to the second question. How do you overcome GDPR in collecting social data and enriching the profiles of the individuals?
Okay, that's an interesting one, and obviously very important. There's a couple of things there. A lot of the social data we see is posted online by individuals. And at times it can be quite personal, such as people putting their dates of birth or birthdays, things like that on LinkedIn. So organizations need to be careful with that, even though it was published by the individuals, it's still an unclear area. Organizations need to manage how they use that data, where that data goes. So data, obviously within GDPR, so EU citizens or persons residing in the EU, you know, organisations need to be very careful if that leaves the EU for whatever reason. Let's say we're looking at offshoring, and also, and it's one of the reasons why organisations haven't really adopted cloud computing models particularly, and tend, as we find, to do solutions in-house and still retain the data in-house. That is changing, and we know of large organizations looking at cloud solutions, but I think it's still unclear. GDPR is really only coming to fruition, and we haven't seen a lot of cases at the moment through the courts and ratifying that, so we'll have to see. But generally, and for ourselves, the social data we would give to organizations is data which is actually publicly available, so to some extent less risky.
Thanks, Colin. And Colin, I would like to add here also that actually there's so much fear about GDPR, and organizations sometimes with this approach of being scared of breaching something, actually misinterpret sometimes. So now it's more and more, it's very important actually maybe to go and talk to your GDPR experts if you have any more detailed questions. But from what we see, it's more about how you interpret it and whether you have enough information, like what takes more priority, like your being compliant with AML or following GDPR. For some use cases, for some situations, actually AML legislation takes priority. So first of all, yes, it is publicly available data, but then what comes first? You need to have full profiles of your customers, and sometimes customers do not tell them the information, they don't update you. So that's we can take this conversation offline if some people want to discuss it further, but it's very important also how you interpret the law here.
Thank you. Another question. You mentioned about collecting data from customers' social media and using geolocation API for CDD purposes. How much of a challenge would that be given the increased regulatory pressures on social media platforms, and also taking into consideration the GDPR principle of purpose limitation?
Again, interesting, goes back to the last point, and you're right. At the moment, a lot of the information is freely available. You know, anyone can join in LinkedIn. If you connect with people, you can see whatever they've put there. Or actually, even on their public profile, you can see who their employer is, where they've worked, if that person chooses to put that information. We don't know where that debate is going, and you're right, in the future that may be more curtailed. But as things evolve, and especially if we look at central repositories, are we looking at organizations working with governments and working together to pull some of this information if it's used in a secure and safe manner? You know, you look at insurance, they share claim information. It's not freely available, but it's available to participants securely. So there are ways around that, but it may become more limited as people roll back on social data and they get more pressure.
Thank you. Another question. Can financial firms achieve a dynamic view of the customer using their existing technology solutions?
So I believe they can, to some extent, of course, depending on which solutions they have, but it is possible, although they will hit a brick wall or a glass wall. I mean, there will be a limitation at some point because of the different changes that might happen in the next couple of years. So I would say today you can use your existing databases and case management systems and whatnot to achieve that. It is probably going to be a more massive exercise than you think, because those systems were not engineered to create a dynamic view of the customer, but it's possible in the short term. But if you look at the challenges, 2 years from now in terms of size of data that's being ingested and the different requirements for each interface, then I would recommend to look at purpose-built platforms for this objective.
Thank you, Yair. What type of technology can resolve the problem of data sharing restrictions between jurisdictions in case of global organization?
Okay, I think that one is less about the technology per se, but how organizations internally use their data. For example, where you have sharing restrictions from one country to another, and here we're talking about the EU, so is that within the EU? And obviously in the past there's been a US-EU debate. You know, there's means of masking data, and really it's for that organization to decide where does the data reside, who needs to see it, and for what purposes do they need to see that data. If it's, let's say, offshore analyst investigators, they may need to see a richer view of that data. Someone working within a front line and within a certain country may only need to see a limited view of data from another country. So, for example, if I have a customer with multi-accounts and multi-customers, what do they need to see from those other countries? There's means around it through managing the data, masking data, and using unique identifiers in systems and choosing what you reveal to different people. But along with all of the data and a lot of these questions, it's really the organization understanding where its data is, who's using it, for what purposes, and how it wants to manage that going forward. The technology is there to do it to a large extent. It's more around the governance and the processes around it.
Thank you, Colin. I think we have enough time for...
Colin, quick also addition here that there is technology, which also, I mean, there are technologies that also allow pseudonymization of data when jurisdictions can't share those. So yeah, look for those, and actually not sharing the full profiles, but just hashtagging and pseudonymizing. Yeah. So, and our technology can actually do that. So that's just addition.
Perfect, thank you. I think we have enough time for a couple more questions. Do you anticipate that regulators will start to expect that institutions have graph and pattern-based technologies to detect money laundering?
Okay, I mean, some institutions already use these, and you know, the graph technology, network technology can be used in one of two ways, really. One is for the detection, and the other is at the end of a process for investigation and analysis, spidering down, looking at patterns. I mean, organizations need to adopt new technologies, the same as AI, machine learning, graph and network technologies to better detect money laundering. It's clear that the existing tools we have serve our purpose now, but don't move us forward and will not do in the future. I mean, there's a discussion with institutions they need to have with their auditors, their compliance, and member regulators to explain what they're able to do and what they're thinking of doing. I think the important thing we find is that financial institution able to explain both internally and externally what it's doing and what it wants to do. We've had experience in the past where organizations have fallen foul of a regulator, not because of what they're doing necessarily, because they're not able to explain it. So I think a lot of this debate is, again, not necessarily the technology per se, but how it's used and how it's been able to explain. But I think certainly regulators, and you look at a number of regulators who have sandbox and work with fintechs, are looking for new technology to be deployed.
Thank you, Colin. And one final question. Do you recommend to segment treatment of high-risk countries or business lines from the rest of the operation from a CDD perspective?
So I would say it's not necessary to create a hard segmentation. If your data management and entity resolution platform is flexible enough, then you don't need to create a hard segmentation. In many cases, the business relationships and the activity profiles are across sectors. So the company you're doing business with has businesses or customers in risky countries, inverted commas, and medium risk countries, inverted commas. So you don't want to segment them out of any whatever loans you're offering to them or any other financial products you're offering them. So I would not recommend the hard segmentation. I would recommend to use a platform that is flexible enough to make you aware of the risk profile depending on the variety of geographies and activities that are there.
Thank you, Yair, and thanks for everyone who joined us. If you have any question, in the screen you can see different emails of our speakers today. Feel free to get in touch with us no matter what the question is. And we hope to see you in our next webinar. Thank you, everyone.
Thank you.
Thank you very much.
Thank you.